Hi, everyone. It's a real pleasure to join this session, and thank you all for taking time off Saturday afternoon, although all days seem to be merging into one these days. And I hope all of you and your families are safe and well. And also really happy to have some of the co-founders of Hatch actually on the call. Nathan is on call, I know, and maybe Jeevan also, and the rest of the team at Hatch. So really excited to join this call. Um, so in this presentation, I'm not going to be try and be a soothsayer, but rather try and give you my reading of the conditions, economic conditions globally, what some of those mean for Sri Lanka, and also, of course, given that Hatch is such a hub for entrepreneurship, I thought it wouldn't be complete if I don't give at least some thoughts or some ideas for what it means for business. But of course, at the heart of it, I'm an economist, so my training and background is as an economist, so I'll naturally be seeing things in that light. And many of you may have different views or additional views from your own perspectives, and I'd love to hear that and engage around those views and perspectives in the Q&A session. So let's get going. So today's presentation will cover a few things. Firstly, the global economy, the outlook for trade, jobs, and consumer sentiment, a few flash data points on that. In the run-up to this video call, I've been asked by a few people, what makes it different this time? Is it a reference point? Is SARS a reference point? Is the global financial crisis a reference point to help us understand what it's going to look like, the economic fallout and recovery? So I thought I'll add in a few thoughts of mine on that. I'll give you a quick overview of the relief and recovery measures globally. I'll also share with you some economic tensions, which seem to be coming out and been kind of playing on my mind and maybe some of your minds also. And then thoughts on implications for the Sri Lankan economy, and then ideas for a few ideas for business. So on the global economy, I think it's very clear to all of us now that a recession is inevitable. Technically, recessions are classified in different ways. For instance, 2 successive quarters of negative growth. But I think all of that right now is all of those rules and definitions are kind of thrown out of the window, especially when we heard the IMF say we are already in recession. And the shape of recovery is also uncertain. Even though Randula said we're taking bets at the end of the session, I'm afraid I might give it away a little sooner, because I do have a slide on what the shape of that recovery could look like. So the global economy is set to shrink by 3% in 2020, according to the IMF, which is a steeper downturn than the Great Recession of 2009, which was a minus 0.7 shrinkage. But of course, moving into next year, most international organizations are optimistic that we'll have a rebound of 5.8% in 2021. But of course, to remember those numbers are of a low base in 2020. And of course, the size and nature of this rebound next year will crucially hinge on 2 things. One, of course, is the containment efforts and the success of those containment efforts of the virus itself, and any signs of reemergence. And of course, second, which is more on the economics, is the success of the relief, recovery, and stimulus measures that are being put forward by many countries, particularly advanced countries. I make a deliberate point to call them relief, recovery, and stimulus, because I know that these words have been used interchangeably. I don't believe that the measures that have been announced now by most countries could even be called stimulus. They are more, firefighting measures, more on the relief and recovery side. And I think there's going to have to be another wave of such measures towards the latter part of this year or next year, which is the real stimulus. So now we're trying to actually keep our head above water, go from -1 to 0. And once we get there, from going from 0 to 1, we're going to need another wave, and that would actually be the stimulus rather than now, which is the relief and recovery. And of course, there's this big debate among economists on what the shape of recovery would be. Bit of an alphabet soup of theories being thrown around. Is it a V? Is it a U? Is it an L? Is it a W? I'll come to that in a little while. And I know Nathan had also put a tweet up this morning about that. So that should be an interesting thing to look at. On the impacts on trade, the WTO and UNCTAD have both put out forecasts. An optimistic scenario on trade is that the volume of merchandise trade, that is the trade in goods, things we put on planes and ships, will go down by 13% this year. The less optimistic scenario, of course, in a situation where, for instance, the virus isn't contained as quickly or stimulus measures are not effective, is that trade would fall a sharp 32% or more this year. If it's around 13%, that's roughly around the same amount during the global financial crisis. Of course, if it's 32% or more, then it's much sharper. Services trade specifically, so even after GFC, services trade was more resilient, more buoyant, and it fell by less, and it also recovered quicker. This time, it's a little uncertain. It could fall by less than merchandise trade again, but of course, we have to remember that travel and tourism, which is a big part of services trade, could be impacted much more than it was during the GFC, and could actually also fall as sharply as merchandise trade. The impacts on jobs, the ILO has come out with a few scenarios on that. A low optimistic scenario is that 5.3 million jobs will be lost this year. And the high scenario is of 24.7 million. This is in comparison to around 22 million at the height of the GFC. And this is in addition, of course, to underemployment, which is what you hear of furloughs and wage cuts or cuts in hours of work, which is not actually job losses, but rather or unemployment, but actually underemployment. Consumer sentiment, we've seen a few surveys come out recently. This is to, I think, the early part of April, the first 2 weeks of April, this came out. And you can see consumer sentiment from these surveys is quite mixed. In countries like US, India, and China, there seems to be some optimism that the economy will rebound within 2 to 3 months. Whereas in some of the European countries, Spain, France, Italy, and also the UK, you can see that there is great amount of pessimism about their own country's recovery. So this is not these countries' citizens' views on the global recovery, but rather their own country's recovery. Now, what would be interesting is to track how this changes over time with the increase in numbers. So this is very, very sensitive to what the folks in the survey must be hearing about the number of cases, the containment efforts, etc. So this is certainly a dynamic position, but at least it gives some snapshot of what that consumer sentiment picture looks like. And of course, as we'll discuss towards the end, this has implications for Sri Lanka because a lot of these countries are our big trade partners, our big export markets. When it comes specifically to Asia, consumer sentiment across Asia is also mixed. You can see that if you just take a very short time horizon of April, you can see the kind of categories of consumption that spending is likely to be cut or increased based on these consumer surveys. And you can see quite intuitively that hotel resorts and stays, restaurants, consumer electronics, and apparel are going to see substantial cuts in spending, whereas some categories of household supplies, in-home entertainment, groceries across Asia are going to see spending increases. So I know this is a short snapshot in time, but we can expect, even if we zoom out a bit more over the next couple of weeks and in the short term, couple of months, that this picture would remain broadly the same. What's interesting, though, that if you just look at China specifically, consumer optimism seems in their own country's recovery seems to be quite sharp, and also in India. But of course, we have to remember that when this survey was done, India was still, China was actually somewhat coming out of the crisis, where India had just about gone into lockdown. So the timing of this matters, but again, gives you some sense of the different numbers coming out. In terms of consumer views around how long household finances or personal finances are likely to be impacted, you can see that it's certainly a fewer number of people who think it'll just be a couple of months, whereas the majority believe that it'll be 4 months or more. Then moving on to this point, I mentioned at the start that some folks had asked me, what's different this time with SARS and GFC? Are those good reference points for us to figure out what happened then, what the recovery looked like? And on both counts, I would say it is different. On SARS, and this is obviously just from an economics point of view, not from an epidemiological or medical viewpoint. So what's different this time compared to SARS? The key point is China. So when SARS hit and China was a big part of that SARS outbreak, China had just about joined the WTO, the World Trade Organization, and had only just begun its global economic integration, global trade integration. Today, very different picture. China is nearly 20 years into its global integration journey. It accounts for 17% of global GDP, when at that time, it accounted for less than 5% of global GDP. So the Chinese economy is much more systemically important to the world economy than back then. China is now the largest export destination for 33 countries and the largest import source country for another 65 countries. Even for Sri Lanka, in many categories, China is the largest import source location. And the epicenter of the crisis in China, Hebei province, where Wuhan is an absolutely vital node in what economists call global production networks for electronics, for automobiles, for machinery of some of the largest companies. So that's one aspect of why this time it's different. It's also different to the global financial crisis because the GFC originated in financial markets with the banking collapse, mortgage collapse, banking collapses, and then the larger banks, and then the overall financial sector. And it then spread to the rest of the economy. Whereas COVID-19 is hitting all sectors simultaneously, almost a perfect storm, a triple shock of demand, of supply, and of finance. And of course, looming above all of it is the medical and health shock. In the GFC, it affected countries differently, right? So those that were more highly exposed to the US banking sector or the EU financial markets, and their markets, demand markets also, were hit harder than others. And you saw a more differentiated recovery where some countries in some parts of the world recovered faster than others. Another distinguishing feature, and I'll come to this also very quickly a little later on, is that post-GFC, or rather when the fires were burning with the financial crisis, there was a global coordinated firefighting effort, which we didn't see, which we're not seeing today. You know, the G20 came together and really took a coordinated response around monetary policy and fiscal policy. And, you know, it mattered because the G20 it accounts for about 85% of global GDP. And we don't see that right now. We don't see that kind of economic coordination. And in fact, prior to COVID, it wasn't a very happy time for global economic coordination and leadership either, because we saw the kind of trade tensions and already that global coordination was on edge. Moving on to some thoughts on the recovery measures. There has been an unprecedented delivery of monetary and fiscal measures by countries, particularly developed countries, the West, but also others, for instance, Bangladesh, closer to home for us. At the time of the GFC, the size of the fiscal responses amounted to roughly 2% of global GDP, whereas with COVID-19, as of now, it amounts to about 3 to 4%, which is already quite substantial. The largest economies have put out about 5 trillion in fiscal and monetary measures. And out of that, the USA alone $2 trillion US dollars of relief measures under their CARES Act. Now, this is significant, and it bodes well for the rest of the world that depends on these large economies as centers of demand, because the more stimulus that these countries have, the more recovery measures and then stimulus that these countries have, and the speed at which they recover is really good for us, because at least the demand slump will recover faster. The big question, of course, is all of this going to be enough? Is even 3 to 4% of GDP of stimulus going to be enough? And I think the only analogy I would have is, and I know this is not going to be medically accurate, but is of a adrenaline shot to the body. I think with the GFC, it was a little clearer where you needed to give the adrenaline shot, how much of a dosage it needed to be, and the timing of it, because it was largely about unfreezing credit markets, easing up constraints in the financial sector, financial stimulus, and so on. And also, of course, in some sectors like automobile in the US. So, it was almost a little more obvious where that adrenaline shot needed to go and in what dosage. My take is that this time around, we don't know where and where else that adrenaline shot is going to go to. Is the dosage right? Is it just one dosage? Is it multiple dosages? Is it just a dosage today? Is it also again in 3 months and 6 months and in 1 year? So I think this idea of that, the size of that adrenaline shot, how many times we're going to have to inject it, where are we going to have to inject it, is a lot more uncertain this time around with this crisis, given the scale and spread, than it was with the GFC. So remains to be seen whether these measures are enough, which is why I also said that I think we're seeing relief and recovery measures now. We're going to have to see another wave of stimulus in these countries, perhaps towards the end of this year or early next year. The nature of a lot of these measures have been through flushing the credit markets, direct cash transfers to households and workers, payroll relief so that firms keep workers employed. And this is good because it'll help to make sure recovery is more rapid. So you're not just injecting it to, let's say, the banks and hoping that that trickles around the economy, but you're actually injecting it directly to households, to workers, to businesses who have folks employed across sectors. You're not choosing tourism, you're not choosing construction, you're not choosing manufacturing. So whether you run a small cafe or whether you run a large manufacturing establishment, most of these countries that have deployed recovery measures are opening it out to everybody. And this is important because if it's not done in an economy, it affects firms and households. With firms, what economists call scarring effects, or longer term effects. The same way, to use a very crude analogy, the same way apparently this COVID-19 disease scars your lung permanently scars your lung and leaves that as an after effect. Even in the economy, if you don't do the right kind of stimulus, you'll have that permanent scarring effects where, let's say in business, you'll lose an entire tier, mid-tier, SME tier could get lost because they can't survive. With individuals and households also, you could see that scarring where many of them are pushed below poverty and they don't have the reserves and the resources to pick things back up when the recovery kicks in. A good example is in Sri Lanka when we have multiple rounds of crop failure or multiple seasons of monsoon failure. The farm, and then you have the weather recovering. The farm households don't have the resources to actually buy the inputs required, seeds, fertilizer, etc., to take advantage of that recovery in the weather and actually make money when the season is good. So then you have a much longer cycle of distress. Within all these support measures, many countries have given SME-specific support. And now the reason I'm putting this is because it's interesting from an economics point of view, but it also might be something for many of you who might be entrepreneurs out there to start thinking about, to start lobbying either through chambers or government contacts you have directly to say, these are some of the measures that Sri Lanka could also be having. So these measures in other countries range from debt finance, like credit guarantees and concessional lines, to cutting red tape and regulations, to corporate tax reductions, or at least, moratoriums and waivers on tax payment, direct cash bailouts, utility payment halts, either directly giving the company the money to pay the utility bill, or giving a concession to the utility supplier or provider saying, don't charge these guys, you bear the cost, we'll give you the money for it. And interestingly, in some countries, they're also giving support for, let's say, vouchers for remote business services. So suddenly you have these SMEs who are having to use remote meetings or remote working digital applications. And there's even support being given to purchase some of these software that they might need. I'm going to skip this and maybe come back to it if I have time, but some of the economic tensions that some of us have been thinking about, I'll share with you at least 3 of these that might be of interest. The first relates to a point I made earlier, that the recovery measures aren't very coordinated right now. And this is certainly a tension and a concern. There's no G20 joint firefighting effort and no clear global leadership around it. And this matters because the only way we can get sort of a synchronized upswing in the global economy is if measures are coordinated and coherent, and whether it's trade or it's fiscal. The impact is greater when it's done together in a coherent manner. So let's see if this picture changes. The second tension perhaps is, and we see this these days in Sri Lanka also, this idea that we don't want the cure to be worse than the disease. So this tension around how soon to lift restrictions, how soon to open up the economy. We don't want the measures taken to cure the virus, or rather prevent the virus spread, to have damaging impacts on the economy, and that impact to be worse. My take, of course, is that strong containment mutually reinforces strong economic recovery, but I understand there could be this tension, and I don't have a clear answer for it, but it's a tension that I think is worth tabling. The third economic tension is around trade policy. And this has been particularly characterized by this view, let's make sure we keep what we have here and ban exports. And this has been particularly true of medical equipment. It's shocking that over 40 countries have introduced, hopefully temporary, but introduced export bans on PPE, on masks and other medical equipment, not just those kind of garment-related ones, but actual electronic and electrical medical equipment. In a very good sign, Sri Lanka's NMRA, National Medicinal Regulatory Authority, has actually lifted an initially introduced export ban, which is good, I guess, for the apparel companies also, so that they can serve the international community that needs these products. And there's a big risk that there will be a beggar thy neighbor type of trade policy adopted by countries and looking inward, being protectionist. And I think we really need to avoid these autarkic and protectionist tendencies, because it's particularly for a small country like ours, we are integrated and there's no turning back from that. It's about how we make the best of it. So before I move on to the Sri Lanka section, Randula, sorry to talk about the bet too early, but I thought I had to stay true to the title of what's the shape of the economic recovery. So let me spill the beans now, at least my view on it. So the recovery shape, I think the debate has been a bit on alphabet soup, V, U, L, W. So let's look at what some of these are. It might help you think about what your own interpretation of the shape of the recovery would be. So a V-shaped recovery would be a very optimistic one, right? Where in the big hotspots of Europe and US, the virus clears up by May and June. Social distancing is relaxed very quickly. Pent-up demand over the last couple of months is unleashed. The government measures to support the economy has succeeded in keeping jobs and businesses afloat, and things go back to normal fairly quickly. I think that's an optimistic scenario. A U-shaped recovery, somewhat optimistic, where the virus lingers on till about Q3. Social distancing isn't lifted immediately and it continues. there is a demand uptick, consumption uptick because of the relief measures being given by countries, but consumers aren't rushing to shop, businesses aren't rushing to hire. So it's a slower recovery and it takes a U-shape, but once it does, it recovers very sharply to pre-crisis levels. An L-shaped recovery would be a worst case scenario in my view, where the virus continues in its present form throughout 2020, social distancing in its present form continues, and the recession worsens. A further injection of relief and stimulus measures are needed, and consumers and businesses take a much longer time to respond to those measures because of the uncertainty. And a W-shaped recovery, I think, is rather pessimistic, is where it's what we call a double dip recession. You had this debate even with the global financial crisis. Yes, just like a V-shape, the virus clears up in May, June. Economic recovery happens like in a V-shaped recovery, but the virus returns in a second wave. Tighter controls are reintroduced, perhaps even more tightly than today because of this second wave, and it really hurts consumer and business sentiment. My take is that it'll probably be more like this, and with no copyright infringement intended, looks a little bit like the Swoosh, Nike Swoosh logo, or a tick, if you will. And that could be a more likely scenario where the limits are eased, the limits are eased more gradually and more carefully than they were introduced. Relief and stimulus measures take time to truly kick in and deliver the results. There isn't an unleashing of animal spirits, but there is steady recovery. There's also different speeds of recovery across different regions, and they're determined by the virus spread and flashes of the outbreak happening as well. So it's different speeds of recovery around the world, which as an average then contributes to a more slow recovery. People and firms remain more cautious of spending. They don't halt, they do go back to spending, but they're more cautious of some types of spending like consumer durables, like travel. But GDP does reach and in fact exceeds pre-crisis levels after about 2 years since the trough. So I think that is a more likely scenario. And I guess the inevitable question is, what's it going to be like for Sri Lanka? I would hazard that for Sri Lanka also, it looks more like this than it does a V, U, L, or a W. With that segue, let's look at some of the implications for Sri Lanka. And I think here there are a few ways to look at it. One is overall, it is a bit of a double whammy for Sri Lanka, and the timing, quadruple whammy for Sri Lanka, and the timing couldn't have been worse. So what do I mean by a quadruple whammy? We had an external supply shock starting December, January, February, particularly with China. An external demand shock, where now because of the lockdowns in our key markets, that external demand shock coming in where we can't get our exports there. A domestic demand shock, or in other words, a domestic economic activity shock because of the curfew and lockdown and so on, and people not spending, obviously, and the domestic supply shock to a lesser extent, but supply shock also because of curfew and lockdown. But on this supply shock, the government has done a lot on the agricultural side, actually, to open up and allow farming activities and agriculture and make sure that some of that activity at least continues. Sri Lanka is much more exposed to international capital markets today than we were during the global financial crisis. We have issued a lot more international sovereign bonds, so we are at the mercy more of international investors, capital market investors. And unlike in the GFC period, tourism now is a much bigger part of our economy. More people depend on the sector, and it has more multipliers across the economy than back then. So, and we know that tourism is going to be badly hit with coronavirus. The other problem is that it comes on the back of already weak growth in 2009, Easter Sunday attacks and so on. 2.3% in 2019, which is, I believe, almost a 2-decade low for us. So it comes on the back of this low growth already. The growth forecasts for this year range from a recession of minus 0.5% to a more optimistic growth of 2.2%, depending on which agency. IMF and ATP have had different numbers. Central Bank hasn't issued any definitive numbers of their own yet. And both agencies are predicting a rebound of 3.5% to 4.2% next year. But again, there are low base effects that we need to consider. And again, same story as with the global economy, it will depend on the medical side as well as the economic side. Spread of the virus, containment, etc., and stimulus measures and the measures taken here, as well as in our markets. On the external account, forex earnings will take time to recover because of the weak growth in our key export markets. So a large part of our exports go to the US, Europe, and UK. And I don't need to mention specifically all of it. You can clearly see negative growth in this year in these key markets of ours, but of course with upside expectation next year. The Export Development Board estimates a near 50% cut in our 2020 exports from the original forecast. And these are all on goods exports, merchandise exports. We can also expect a fall in services exports. Our major services exports are tourism, IT, and international transport. And of course, we can expect a fall in those as well. The other aspect of our forex earnings is remittances, and it's a big part of our economy, and it covers a substantial amount of our import bill. For two reasons, our remittances are likely to be impacted. One is a big host region for our migrants is the Middle East, and we've always seen that when oil prices are low, there's a negative wealth effect in these countries that are oil exporting countries of the Middle East, and it's going to affect our remittance earnings from workers in this region, in these regions. The other aspect is in other regions outside of the Middle East, like Italy and South Korea, we've had returnees because of the virus outbreak, returnees of our migrant workers. So they're not there and earning money and remitting back. Also, those who are there are going to suffer from the same issues that the people in those countries suffer from, the reduction in wages, loss of jobs, etc. And then you also have new folks. So you have cycles of migration, folks who return and then go back, return and then go back. And you're not going to have that return, folks who are going back to these countries because of domestic restrictions in Sri Lanka preventing them from going, and also restrictions in those countries. So for a few different reasons, remittances are likely to fall fairly sharply and take time to recover. On the macro, I won't go into too much detail on this because I know you had a great presentation by Desha on the Hatch series last week. But just for completeness, let me put forward the fact that a lot of the pre-existing issues that the Sri Lankan economy had now become more pronounced. So on the fiscal side, we have limited space for any large-scale relief and stimulus compared to what some other countries are doing. On the debt side, investors are obviously now in risk-off mode, which will make it harder for Sri Lanka to borrow internationally, even though Fed risk-free rates are lower. In the financial sector, domestic financial sector, we've already had high non-performing loans and the moratoriums since 2019. But now we're also seeing the onus of giving relief once again passed on to the banks. So the financial sector is going to be under a fair amount of stress. On growth, mentioned earlier, we already come on the back of weak growth, and there were tax cuts intended to boost growth, but that benefit was kind of wiped out with the coronavirus outbreak. On the currency, in times of crisis, investors flee to so-called safe haven assets like US Treasuries and US dollar. We've seen that with emerging markets and frontier markets like Sri Lanka also. And as a result, for instance, in the Sri Lankan government securities market over the last 6 weeks, we've had about a 66 billion outflow. The good news, if we can call it that, is that around the world, the multilateral and bilateral lenders seem to have come out quickly with offering relief packages. So Sri Lanka can apply for some of this debt relief, even though we're not low income. There are some facilities for even middle income countries like ours to approach and try and get debt postponements. We also have our bilateral friends, China, Japan, etc., who may come forward. We could go for forex swaps with these countries, with India and so on. And we just heard earlier this week that the Sri Lankan government has approached the IMF to access this one particular line of emergency money called the Rapid Financing Instrument. The other implication for Sri Lanka is less on the macro and more on the business side, and more with regard to particularly also with manufacturing. And it's something that I've been writing about for about a year now, since the trade war. I was, in the context of the trade war, we were really expecting a redrawing of supply chains. And I think that's going to accelerate following COVID. There's been a debate about whether it'll be a decoupling. Will we see a large-scale decoupling of supply chains between regions, West versus Asia, for instance? But my take is that it'll be more of a recoupling or a redrawing, reconfiguring. And as I said, the US-China trade war had already triggered some of this thinking among global firms as a risk management strategy. And interestingly, I think we're going to see a shift in focus in the supply chain designs from ruthless emphasis on efficiency, so cost. We want to be in the lowest cost locations, to saying, okay, maybe we have some of that, but we also really need to make our supply chain resilient. And the shift of focus to a resilient supply chain will be characterized by greater regionalism and shortening of the supply chains, perhaps. Definitely geographic diversity, where if they have a large part of the supply chains located in one region, say East Asia or only Southeast Asia, there may be a lot more focus on saying we have that and we want South Asia and we want a bit in Africa. So a de-risking, deconcentration, not being overly concentrated, capping their exposure in certain countries. And also a partial reshoring or even domestication of part of the supply chain. So I think that's, it won't be a total, hard decoupling as some are predicting, but more a recoupling and a redrawing. And I think this has a lot of interesting implications for Sri Lanka, particularly when we see countries supporting businesses to do this relocation. So a couple of weeks ago, the Japanese government announced that as part of their stimulus package, they're actually going to pay companies who are in China, Japanese companies in China, to move production away from China. And not just about coming back to Japan, actually saying wherever you choose to go, we will support you because we think it's more important for our Japanese firms to have resilient supply chains. And that's a very, very interesting move. It reminds me a little bit of the opportunity we had in the first wave of Japanese outward investment. And I'll get to that in a second. So I think this is a real opportunity for us on trade and FDI if we act early, because the same way Sri Lanka is thinking about this, Cambodia is thinking about it, Vietnam is thinking about it, Bangladesh, Thailand, Myanmar, everyone is wanting to get a bit of this action of the redrawing and recoupling of supply chains. I think that a big psychological barrier of firms who didn't want to move to higher cost locations and they want to be ruthlessly focused on efficiency, I think that psychological barrier has broken, because now this thinking around resilience and de-risking is now coming up more. And it's not just only about cost. So Sri Lanka needs to proactively attract firms looking for new locations. For example, those who are looking to get out of China. I think a low-hanging fruit for us is working with Japan, given our existing good relations. We have JETRO and JICA agencies present in Colombo. We have many long-term existing Japanese firms who are operating here. And like I said, it really reminds me of that first wave of Japanese outward investment, which we missed in the early 1980s. We had firms like Sanyo, Matsushita Corporation, Marubeni Corporation, who were ready to set up electronic manufacturing in Sri Lanka. It was the first wave of Japanese outward investment. We missed it because the 1983 violence broke out. They left, they never came back. They went to Penang, Thailand, etc. Maybe this is our second chance. And we don't have war and violence right now. We have much more stable security conditions, but we have to be proactive. And if folks might ask, so what are the reforms we need? What do we need to do to attract them? I would argue that it's the same stuff that we always needed to do. It's the same reforms that were needed pre-COVID that are still very valid today and will be valid post-COVID. So trade facilitation, things like the National Single Window and digitizing border agencies, making it more efficient. Investor promotion and facilitation, a predictable tax regime, progressive trade policy, of which one part would need to be FTAs, and deregulation and making procedures easier for business, global business, but also local business. So I think if we do these things and act early, we can really latch on to this opportunity. Final segment is on some ideas for business. So taking my economist hat a little bit off and putting some ideas that might spark some interest. I think one of the first things that businesses would need to do is to put your business in the mirror and then take it to the gym. What do I mean by that? Is to do a quick health check on how your business is run. Do you have good visibility on your financials, on your bank debt? Have you talked to your bank about the possible packages that are available and restructuring those bank facilities? Do you have sensible human resource and performance management systems in place? And it's a really good time to take a close look at your efficiency, internal efficiencies, how you manage your inventory, how you manage your suppliers, your customers. It's a good time to really look in the mirror and get fit and be ready for the recovery. It's also a good time to look at strengthening the core of your business and making sure you have the space to do the new things that could come up post-COVID, the new opportunities. If you don't look at that core and try to make that lean and mean, you won't free up resources to go after some of the new opportunities that could come up. What would some of these new opportunities could be? And again, it's a humble economist view, but many of you who are actually entrepreneurs might have already identified new opportunities, and I'd love to hear about them. I think there's a lot of opportunity for services that help businesses de-risk their business, particularly the SME segment, but not only. De-risking their supply chains, operations, their financials, their debt picture, and so on. I think there's a big opportunity for folks, whether it's digital or otherwise, that helps firms de-risk. For example, let's say an over-reliance on cash could be one aspect of the risk that you want to de-risk. The other, I think, is somewhat of an obvious one around digitization. And here, I mean, a very specific aspect of it, where I think we've all come to realize that there are a whole bunch of companies in Sri Lanka, large listed ones, but also smaller ones that require digital transformation and helping some of these legacy businesses become digital. They've all been exposed, their digital weaknesses have been exposed. I know we have a lot of very competent, very competitive IT companies serving global clients. I think they're going to have a big opportunity here to serve this digital transformation of domestic legacy businesses. I think a third opportunity is the public sector and public sector digitalization, particularly related to trade services, border regulatory agencies. There'll be a lot of opportunity for tech companies to partner with these and talk to ICTA about these opportunities, because again, the public sector digital quotient has been exposed during this crisis. A fourth opportunity, and I believe very strongly about this, and I think it links Randula to the GLX that Hatch is running, the Good Life Accelerator. There's going to be a lot of a heightened focus on food safety and food standards. The Western consumer is going to be a lot more discerning of where their stuff comes from, what are the health and hygiene conditions. And I think Sri Lankan food and beverage products exports that have a focus on food safety, quality standards, and global certification will do very well. And it's not just the big guys, even the small guys, because these global certifications are recognized whether you're large or small. I think another opportunity is that we have this new cohort of older folks, for instance, people like my parents, who have been forcibly drawn into online channels and e-commerce. This, I don't think we realize it, but it's unprecedented and unexpected. I think all of the digital businesses, e-commerce, tech, and so on had kind of written this group off. There's no way we can onboard these guys. Cost of conversion is too high, et cetera, et cetera. This is an event that has forced that segment to come in and engage with these products, these platforms, these services. And now let's not lose that, right? Let's make sure that this new segment that has opened up is a profitable part of the business. And the final is an opportunity, but also to say that businesses that had cultivated stickier and quote unquote deep and meaningful relationships with partners are going to do a lot better. And you're seeing that with some of our exporters, folks who had deeply embedded themselves into their customers' supply chain, into their customer, and the customer relationship was tight, and it's much harder to throw these guys away because you're now in it. You're in it with them. You understand their business. They understand your capability. You build trust on quality, on delivery. So you might be way low down on the list of folks they're going to can. So I think that's another opportunity for really cultivating deep and meaningful, sticky relationships. These are just some of the sectors and opportunities. There may be many others. So here's at least two ways in which you could think about, or framework with which to think about what these new opportunities could be and how to act on them. I think one is at a macro level, looking at what are the economic and sectoral changes that Sri Lanka is likely to face. For instance, ask yourselves, is there a fundamental weakness that will remain post-COVID, that was there pre-COVID and will remain post-COVID? For example, digital citizen services. Are there structural shifts that will occur post-COVID? And I think the focus on local agriculture and agricultural value addition, smartening up the supply chain in ag will be that kind of structural shift, for instance. And in these economic and sectoral changes, obviously we need to ask, is it just going to be government that ends up fixing this, or is there room for a commercial fix? And if it's the latter, then you know that there is opportunity there. Or even if it's the former, it might be through partnership. So that's one way of looking at it at a macro plane. But at a consumer behavioral plane also, I think it's important to ask, to think twice, because we might see a trend and a sudden shift today, but we'll need to ask ourselves, is this temporary due to the constrained options today? People are doing it because it works for now. But if it wasn't COVID, if it wasn't curfew, we wouldn't be doing it. Or do we think that this is a trend that's potentially here to stay? So that's one question you could ask. And for this, you could do a quick assessment through, with your customers of usage during COVID versus intent to continue. And it'll give you somewhat of a quick sense of, is this trend here to stay and can I make a business out of it? So that's, I know it took a little longer than I expected. I apologize for that. Thanks for sticking with me.
Thanks once again, Anush, really, for taking time to prepare this presentation with all that you're doing behind the scene to keep all of us afloat, to come and speak with us. We are rolling this series out called Hatch Resilience Series, especially to bring insights from experts who are working to help us navigate through this crisis, and also bringing insights from entrepreneurs themselves who are actually doing quite a great job out there to help us navigate through this. So stay tuned in for all of our sessions coming up.